So in this video, we are going to discuss about the sources of finance. So we'll start discussing about equity financing. So we'll start with what is equity and we will proceed. So equity is partial sale of ownership in the business to raise finance. So people think that if they are going to issue equity shares, they are going to make money without giving up anything, but it's not like that. So equity is a sale of the ownership in the business to raise finance. So we'll put it like this. Assume that you are a 100% owner of a company and the company's worth is around 10 crores and you are able and you want to raise around some 4 crore of cash. So what you do is you have to sell 40% of your business. So now what you sell is the ownership and you also sell the control in the company. So it's not that equity financing is a free source of capital. You are selling your ownership rights in the company to someone else. So there's also a danger here. For example, if you sell 40%, it's fine. But if you're going to sell 80% and you want to raise around 8 crore of finance, then you are not the majority owner. You become a minority owner because 80% shareholder will become the majority and 20% stakeholder, that is you, who have 22 crore worth of shares, will become a minority stakeholder. So what happens is if the majority percentage of people feel that they want to change the CEO, now they can pass a board of resolution and they can change the CEO easily. So it's not that there should be like 80% of all the shareholders have to agree. Even if 51% of the shareholders, if they agree, you can be out of the company. So it's always dangerous to issue too much of equity shares because you are going to sell your ownership and control in the company. So equity can be raised in the following ways. So you can go for an initial public offer, placement, or a rights issue, or venture capital. So what are the advantages of equity? So the advantage of equity is you can raise a large amount of capital and there's no compulsion to pay dividends. Like in debt you have to pay interest compulsorily, but in equity there's no compulsion to pay dividend. 1 year you can pay, another year you can skip. What's the disadvantage of equity? The major disadvantage is the loss of ownership, and the cost of capital is also higher because equity shareholders take a lot of risk. So what happens is we have to pay them in terms of dividend and share price appreciation. So both these things we have to give, or sometimes if you give a high dividend, then the share price appreciation can be lower. If you give a low dividend, then the share price appreciation should be higher. So if you give both as high, then the equity shareholders will be very happy, but if you give both as low, then your share price will be like very low. So that is about equity shares. So we'll discuss the various methods in which you can raise equity finance. So the first one is initial public offer. This is the most famous. So assume that you own a company and you decide to sell a part of your shares. The way you can sell a part of the shareholding in the company to the general public. So what you do is you plan for a IPO, initial public offer. So initial is this is the first time you're going to initiate selling equity shares, and you're going to give the shares to the public, and it is a offer to the public to purchase your shares. So that is what initial public offer refers to. So what you do is in an IPO is you print out an invitation, something called as a prospectus, which contains all types of information about your company, your sales, your profit, your accounting, and all kinds of information about your company, corporate governance, risk policy, and you give this information to the public. So the public, what they will do is they will buy this prospectus and they will read it, and finally if they really like the company, they will try to buy the shares. So An IPO is a means of selling the shares of a company to the public at large for the first time. When companies go public, okay, when you issue a share IPO, it's called as going public. So when companies go public for the first time, a large issue will probably take the form of an IPO. So if you want a large amount of cash, then people go for IPO. This is also, IPO is also called as a flotation. The shares issued in the IPO can be traded in the stock market thereafter. So the first time you're going to issue the shares, it's called as the primary market. Thereafter, trading it is called as the secondary market. The subsequent issues are likely to be placing or right issue, which we'll describe later. So we'll discuss about what is the advantages of having a stock market listing. So these are the advantages of a stock market listing. Number one, improved marketability of shares. So once you list in an stock market, what happens is there's a high visibility of your company and your company's share. So if people want to sell or buy the share, they can do it in the stock market. Okay, so there's a good marketability of shares. Public image is enhanced. The original owners of the company can realize some cash. The original owners selling holding to obtain for other projects. So if you are a owner of the company and you have a plan to make the company much more bigger, what you do is you try to issue shares. So you can also grow by acquisition. So you can give your company share and buy another company's share. For example, if you take a Nestle company, so Nestle company can give their shares and buy the shares of X Limited. So you don't companies can buy other companies by giving their share. For example, in a ratio of 1 is to 10, for every 10 shares of X Limited, one share of Nestle company might be paid. So it is easier to seek growth by acquisition. And next one is access to a wider pool of finance. So once a company has listed in stock market, it opens a door to raise more finance. So the credibility of the company is much more higher, and banks and financial institutions will be willing to lend to such company. So these are the advantages of a stock market listing. So now we look at the disadvantages of listing. See, as long as you are a private company, you don't need to submit your accounts or annual report to any government institutions. But once you have become a public company, that is, if you have raised money from the public, then there will be a greater public regulation because you are using public's money to run your company. So there will be greater public regulation, accountability, and scrutiny. The legal requirements the company faces will be greater, and the company will also be subjected to the rules of the stock exchange. So once a company has listed, the tax authorities, the stock market authorities like SEBI, NSE, BSE, then the company's law. So you have to comply with a lot of rules and regulations. So that is the major disadvantage. You should also appoint a company secretary to comply with all these rules and regulations. A wider circle of investors with more rigorous requirements will hold shares. So what happens is the number of shareholders now become a wider circle, and they have to comply with we have to satisfy their needs also. So that becomes another problem. There will be additional costs involved in making share issues. To issue shares, we have to pay brokerage, we have to pay commission, we have to pay underwriting fee. So it is not such an easy process to list a company. It takes months of time. It takes a lot of experts' advice and hard work to make a company listed. So these are the disadvantages of a stock market listing. So there are good things about going public, and there are like disadvantages for going public. So a company before going public has to decide which one is the best option, and they have to choose the better option. So now we will move on to something called as a placing or placement. So a placement is an arrangement by which instead of offering the shares to the general public, okay, instead of offering the shares to the general public, the sponsoring investment bank arranges for most of the issue to be bought by a small number of individual investors, usually institutional investors. Okay, so here what it happens, rather than selling the share to public, the shares are sold to few institutional investors. So the company is not listed, but still the company is able to raise finance from a few of the institutional investors. So the choice between an IPO and placing are this. Placings are much cheaper and useful for small share issues. So if the company wants to raise a small part of their equity, then they can go for placing. If the company wants a high amount of money, then they have to go for uh, IPO. Placings are usually much quicker because only few institutional investors are required here. Placings are likely to involve less disclosure of information. See, still the company is not a public company. So what happens is that the regulatory requirement from the government side is much more lesser, as most of the shares will be placed with a small number of institutional shareholders who gain control over the company. So what happens is, as the number of shareholders are less, then the shares that they hold can be much more higher, and they can start to have control over the company. For example, out of your company is worth 10 crore and you have 100% ownership. So what you do is you raise 2 crore and you give 20% of ownership. So 80% still you are the owner. You are the owner. But the problem is now institutional investors have 20% and you have 80%. So still they will influence you. Okay. So you can't be like free and all. They will be like starting to influence you. So that can be a problem. So we'll now move on to discuss what is a rights issue. A rights issue provides a way of raising new share capital by a means of an offer to existing shareholders, inviting them to subscribe cash for new shares in proportion to their existing holding. So this is available to a company which has already issued shares. Okay, so the company should have gone for a IPO first, then only they can go for the rights issue. So assume your company is worth 10 crore, and what you do is you have gone for an IPO and you have raised 4 crore, selling 40%. So after 2 years of time, you again feel that you need much more capital. So this time you need another 40 lakhs. So you will go for a rights issue. So 40 lakhs is not a huge amount of money. Okay. And you don't need to again go and issue a fresh set of shares to a new shareholders. What you can do is you can ask your existing shareholders to give that 40 lakhs. So you'll mark it as 0.4 crore. Okay. To raise this 0.4 crore, what you do is you just need to ask the existing shareholders. Okay. So if they are going to purchase again a 10% of the shares, okay, whatever they have, if they are going to purchase another 10%, if they can add another 10%, you will get 0.4 crore. That is, for every 10 shares they hold, you ask them to buy one share of the company. So if they are going to hold around some 40 crores of shares, then you're asking them to buy another 4 crore of shares. Okay, so whatever is their number of shares they hold, you ask them to buy an additional percentage of share. So what are the advantages of having a rights issue? Rights issue are cheaper than IPO, right? It's a very it's only to the existing shareholders you ask, so it's very cheap. Rights issue are more beneficial to existing shareholders. New shares are issued at a discount to the current market price to make them attractive to investors. So the shares are not issued at a current market price, the shares are issued at a lower price. So assume that the current market price of a company is, the same company is 20 rupees per share, but the rights issue price would be something like 16. So that's an effective discount of like 20% discount in the share price is given. So this motivates the existing shareholders to purchase the share. Relative voting rights are unaffected. See, the shareholding pattern does not change because the existing shareholders are again given some share. For example, we can again put it like this. You hold around 10 shares and the total shares in the company itself is only 100 shares. Okay, so if the company is going for a 10% issue, then what happens is the total number of shares become 110. So if you are going to buy one more share, so 10 plus 10% gives you 11 shares. So you have 11 shares after the rights issue and the total shares is 110. Initially you had 10% of the total shares. Now also you have the same 10% of the total shares. So proportionately you buy share. So that's what relative voting rights are unaffected if shareholders take up their rights. So you have to buy the additional shares. The finance raised will lower the debt equity ratio as more equity are raised. So if you take a debt equity ratio, so you already have a debt of 100 and the equity of 100. Equity share if you raise, it is like 20 rupees you raise, so it becomes 120. So the debt equity ratio will fall. As the denominator rises, the debt equity ratio will fall. Okay, so that's why it says it will lower the debt equity ratio. So that's about the rights issues. So now we will move on and discuss about venture capital. See, venture capital is a risk capital and normally it is provided by a person or a company called as venture capital firm or a venture capitalist. So what do they want is a return for the equity stake. So venture capital is a capital that is invested in private companies. So in public company you won't have venture capital. Only in private companies you will be having venture capital. The venture capital may be provided by a wealthy individual also, or it can be a firm. Venture capitalists seek to invest cash in shares in private companies which have a high growth potential. So the major thing that they will look at is whether the company has a high potential to grow. If it's going to grow a lot, then they will invest in those companies only. They seek a high return which is often realized through a stock market listing. So once they, we'll put it like this, assume they want your company is having 100% shares and you are the owner and it's worth 10 crore. The venture capitalist will give you, will buy 50% of the share, so he will give you 50 crore. So this venture capital and this is you. Okay, so once he has provided, after some 5 years, what he will do is he will ask you to go for a IPO and he will sell his 50% of share at the market for around some 20 crore. So if you put it, his profit would be 15 crore. So for the time he waited, he had made some money. So where do venture capitalists invest? They try to invest in young startup companies but is more commonly invested in small companies that already have a track record of business development. So they develop in startup companies, and they also invest in companies which have a track record to prove. These companies may have borrowed as much money as their bank are prepared to lend and do not have enough equity capital. Okay, so which companies go for venture capital money? What happens is a company would have raised a lot of debt and equity is very low. So debt is very high, equity is very low. So they can't still go for debt. At that point of time, they go for equity. So that's what it says. These companies may have borrowed as much money as their banks are prepared to lend. So borrowing has been done and do not have enough equity capital. So what they go is they now go for equity capital to expand at the rate or scale required. So now we'll move on to stock split. So stock split is not a source of finance, but still we'll discuss about stock split as we are discussing about equity. So what is a stock split? A stock split is a decision by a company's board of directors to increase the number of shares that are outstanding by issuing more shares to the current shareholders. See, assume that your company has shares. Before the stock is split, you have 1 crore share and the share is trading in the market at 10 rupees. The total market capitalization, that is the multiplication of the number of shares into the share price, will give you the market capitalization. So you have 10 crore worth of shares. After the stock split, what happens is the stock split is 2 for 1. Okay, for every one share, 2 shares are given. Okay, so the total number of shares in the market now becomes 2. So 2 stock split becomes 2. But what would happen to the share price? See, the 10 crore worth of the company will never change. So that will be the same. But the number of shares have become 2 crore. Okay, so the number of shares have become 2 crore. What would happen is the share price would effectively reduce to 5. Okay, so this number will just flow as before the split. The 1 crore share will become a 2 crore share, and by multiplying like this, the share price will fall to 5. Okay, so this is stock splits work. Stock split will not make the shareholder rich or anything, but what would it make is the number of shares will increase and the share price will decrease. Okay, as share price is decreasing, it is now easier to trade the share. For example, there's a company called as MRF. Okay, the share price of this share is around 60,000 rupees INR, Indian National Indian rupee. 60,000 is a per share. Who can buy this share? It's very hard to trade or buy this share. So they could go in for a stock split. I think stock split could be given as 1,000 shares. So if they give 1,000 shares as a stock split, after the stock split, MRF's share price would fall by 1,000. So now it will become 60 rupees. Okay, 60 rupees is much more of a smaller money, and people will start to buy the company, and the trading will happen much more effectively.